$16 billion, that's what Meta lost on Metaverse. Investors barely noticed. Here's why your portfolio should be terrified. If you own Meta stock for dividends or expect buybacks to support total return, you're relying on a financial narrative that may not survive the next 18 months. This is Boardroom Files research. And we analyzed Meta's 10K filings to expose what CFO Andrew Bosworth didn't emphasize on the earnings call. A cumulative $16 billion Reality Labs operating loss compressed into non-GAAP messaging, while guidance promised capital efficiency. By the end of this video, you'll know exactly where that impairment lies in the filing, the 3 red flags to spot in any tech earnings before you trust the buyback story, and why a $100K tech-heavy portfolio could face an $8K, $75K repricing when this narrative shifts. Let's start with what the research shows. Meta's Reality Labs segment, the VR/Metaverse division, posted a cumulative operating loss of $16.2 billion from 2021 through Q3 2024 per the company's 10K disclosures and quarterly filings. That's $16 billion in cash burned on a bet that didn't materialize. Now, here's the problem. When Mark Zuckerberg and Andrew Bosworth discuss earnings with analysts, they don't lead with Reality Labs losses. Instead, they emphasize AI CapEx intensity, claiming it's a necessary capital deployment for competitive positioning. The reality, Meta is simultaneously hiding a massive impairment while asking investors to trust increased CapEx guidance. The impairment itself appears in the 10K footnotes, not the headline operating loss. Specifically, Meta took a $1 billion goodwill and asset impairment charge in FY 2023, largely tied to Reality Labs restructuring. By FY 2024, the segment's annual operating loss alone hit approximately $4.3 billion if we extrapolate Q3 2024 pace through year-end. Cumulative losses exceed $16 billion. The delta, an investor relying on 5-7 years of historical buyback pace, $30B, $40B annually, to anchor a total return assumption could overestimate sustainable distributions by 15-25%, translating to $4.5B, $10B in misallocated cash flow. A household with $100,000 invested in Meta at recent valuations might assume $2.500, $3,000 in annual buyback support to returns. If CapEx reallocation forces a buyback pause or reduction, that expectation evaporates. Here's where it gets worse. The GAAP vs. non-GAAP reconciliation tables show that Meta's reported operating margin excludes stock-based compensation, but not Reality Labs operating losses. Those flow into GAAP net income. However, on earnings calls, management discusses adjusted metrics that de-emphasize the cash impact of Reality Labs, burying the headline. Compare this to historical precedent. In 2000-2002. AOL Time Warner took massive write-downs on failed merger synergies and media assets, yet guidance remained bullish until the street repriced 12-18 months later. The delay wasn't accident, it was narrative management. So what are the 3 red flags to spot before you trust the next tech earnings call? First, compare CapEx guidance growth rate to free cash flow growth rate. If CapEx is rising 20%, 30% annually but FCF growth is flat or declining, the company is burning flexibility. Meta's 2025 CapEx guidance calls for $37B, $40B, up from $29B in FY 2024, a 35% increase. If revenue growth doesn't accelerate proportionally. Dividend coverage deteriorates. Second, dig into the 10K footnotes on asset impairments and restructuring charges. If a megacap took $5B plus in write-downs in the prior 2 years, ask whether management has materially changed capital allocation strategy or simply repackaged the same bet under a new name, like pivoting from metaverse to AI. Third, cross-reference earnings call transcripts with proxy statements on executive compensation. If the CEO is being paid partially in cash bonuses tied to FCF or profit metrics, but the 10K footnotes reveal multi-billion write-downs, the incentive structure is misaligned with disclosed risk. The stakes are clear. If tech megacaps can systematize the burial of $10B plus failed bets into footnotes or off-balance sheet accounting, dividend and buyback-dependent investors may not discover deteriorating cash flow until distributions are cut, potentially 12-24 months after insiders knew. For the full analysis, case files, and the spreadsheet cross-referencing Meta's CapEx intensity against peer buyback sustainability. The deep version is in the companion book, The MSTR Bitcoin Trick, link in the description. If this exposed a blind spot in your portfolio thesis, hit subscribe. Next video covers the 3 megacap tech stocks with the highest hidden CapEx to dividend ratio, dropping Thursday. Ring the bell. In strategy, the quiet observer wins.